Chris, let me just start with you and why you think that sort of the intensity of this move is something people need to understand what the Fed just did here.
Yeah, for those of us who managed money in '08, Kelly, this is a refreshing thing, actually, because in '08, the Fed fixes that we saw over the past weekend literally would have taken weeks. They didn't have the authority to do it. They would have had to go to Congress. So in one weekend, the Fed has backstopped not just deposits below 250, but every single depositor of Silicon Valley and of Signature, and has also stood behind the depositors of banks that have, that don't have those kind of problems yet. So that's a really big deal. I don't think the market appreciates it, mostly because I think it happens so quickly. They think, well, anything that happens over a weekend can't be that great. But when you read the details and the amount of liquidity available to the banks, it's really quite impressive and very quick.
Is it going to engender more pushback as people, there were some who said over the weekend, okay, this was the right thing to do now, but within a week we need to set up a new system for FDIC insurance because now there's an implicit backstop to every bank deposit in the country.
Yeah, clearly when they say that it's not going to cost the taxpayers anything, there's some stuff going on there, because if that's true and it's all going to be borne by the FDIC, that means FDIC premiums are going to go way up. So that's an issue, and that'll get talked about, but that can get talked about when things calm down a bit. What I'm mostly concerned about is stopping a 1930/2008 run on the banks, and I think the Fed has acted quickly, and I think it's done that.
Michael Schumacher, have you ever seen the 2-year act like it did yesterday? And what do you think the ramifications of that will be?
Kelly, you'd have to go back a long time. So it's the biggest move in the last 20 plus years, bigger than after 9/11, bigger than the day Lehman plummeted. So it's just a monumental move. And I think the problem is you've got so many cross currents. People are really struggling with, does the Fed focus first on inflation? How does it deal with the issues in the banking system? And that calculus is changing almost minute by minute, hence just the enormous moves in twos.
Do you, Michael, think that positioning-wise, people are going to blow up as a result here? Or do you think we can have a move like that and kind of go, all right, well, moving on, nothing to see here?
Yeah, it's funny, Kelly, if you were Rip Van Winkle, let's say, and woke up today and looked at the markets, you'd say, not that much, frankly, has happened so far this year. But the roller coaster ride, it's been amazing. So it's a little bit far-fetched to think no one's been hurt, and yet we've, I think, got too little time so far to try and assess all those things. It'll take a while to flow out into the markets.
And Chris, this got to be positioning-wise an interesting one for you, because on the one hand, you're saying, look, they've acted swiftly, we're back to calmness, but you still think we're likely heading into a recession. So yeah. What do you do here?
I mean, there's a big difference between a financial crisis implosion and a Garden-style recession. And I do think we're still headed for the Garden-style recession. I think that the failure of Silicon Valley Bank is just one more piece of evidence that when you raise interest rates that quickly, things will start to break. So that will be domino number one. I think we'll see a number of indicia as the months go on here. I think the Fed has to continue to raise based on this morning's inflation numbers. And so, we're speeding down a cul-de-sac, Kelly, and I don't think there's a happy ending in the short term, but I do think we've avoided a banking crisis, and that's the big news for this.